Now that we've adjusted our books to be compliant with the GAAP revenue and expense recognition principles, and we've checked that we still have debit or credit equality on our adjusted trial balance, we are ready to make our financial statements. And we're always going to prepare our financial statements in a predetermined order because each statement that you make typically has a number that you have to carry over to the next statement in the process. So you'd start with your income statement, which would tell you the amount of income that you made during the period. That number is needed for your equity statement because the equity statement is going to show how the value of the business changed during the period. And one of the things that's going to change the value of the business is how profitable you are, your net income. So you need that number from the first statement to make the second statement. And then on your statement of stockholders' equity, it's going to show how all of the equity accounts you had changed in balance during the period. Well, you need to report those equity accounts on your balance sheet. So you need to bring them up to their current balance on your statement of stockholders' equity first before you can transfer those numbers to your balance sheet. And then on the balance sheet, it's going to come up and determine to you what your different assets and liabilities are now, and you're going to need how those compare to your previous periods for your statement of cash flow. So you have to prepare your financial statements in this order: income statement, equity statement, balance sheet, and statement of cash flows. So, starting with the income statement in the simplest possible form it can come in, all you're going to do is take your revenues and subtract out your expenses. If Plush had $167,500 worth of earned recognized revenue during the period, and they paid $74,000 worth of incurred expenses, I should say incurred $74,000 worth of expenses, the difference between those two numbers, or $93,500, was their net income for this year that ended December 31st, 2025. And now that we have that number, that's the number that's going to get transferred to our next statement, which is our equity statement. And this is the statement of stockholders' equity. There are different versions of the equity statement, but this one is by far the most popular. And it's very similar to the statement of owner's capital that you've probably seen before. But that document, the statement of owner's capital, only shows the change that you had in the period to your company's overall or total equity, whereas the statement of stockholders' equity shows how each individual equity account you had changed during the period. But it's still the same concept. You take what it was at the beginning of the period, add to it any additions that you could have had to equity during the period, subtract out any subtractions you could have from equity during the period, and it gives you your ending balance. You just do it account by account. So Plush had $60,000 worth of common stock on their books when this period began. During the period, they raised another $80,000 by issuing new shares of common stock. Well, that brings its new balance up to $140,000. The other component of equity, retained earnings, they were already retaining $40,000 worth of earnings at the beginning of the period. During the period, they had $93,500 worth of net income. We just got that number determined on our income statement, so we bring that on over. But they also declared, in this case, paid $2,000 worth of dividends. Well, this is retained earnings, how much they kept. So let's look at it this way. We made $93,500, but we didn't keep all of it because we paid out 2,000 of that as distribution to our owners during the period, which means we only kept the difference, which is $91,500 out of our income. We retained $91,500 worth of earnings during the period. And if we add that to the 40,000 that we already started the period with, now we're retaining a total of $131,500 of past profitability. So the total equity column is basically just the sum of everything that's in the row right there. We started with $100,000 of equity on our books. We increased it by $80,000 by issuing stock. We increased it by $93,500 by generating income, but we decreased it by $2,000 by taking money out of the company and giving it to our shareholders. But all in all, that leaves us with an ending balance of $271,500. And this number in the right-hand corner is not just the total of this row right here. It's also the sum of the ending balance of each of your individual equity accounts. And right here, our company, Plush Service, at the end of the period, is worth $271,500 to our shareholders, which is the number that we need, all of these numbers right here, we need to transfer over to the balance sheet. And the balance sheet is a statement of what we own, our assets, what we owe, our liabilities, and ultimately what our company is worth to our shareholders. And these two numbers for common stock and retained earnings, as you'll see down here, are exactly the same is these numbers that we had on the end of the equity statement. So we're just bringing previously calculated figures over to our balance sheet. As far as your assets and your liabilities go, you would take those right off the adjusted trial balance. But it is the balance sheet. And on this, your accounting equation should be true. And for Plush, it is true. Their total assets are $336,000, which is completely equal to their liabilities and stockholders' equity. Their books are balanced and in order. This company has far more assets than they do liabilities, which means their equity is quite high for their shareholders. You want another way to conceptualize what total stockholders' equity is? It's how much money would be there to be distributed to shareholders if the company converted all its assets to cash, paid off all its creditors, the liabilities they owed them, and then distributed every penny that was left over to the existing shareholders. So with your balance sheet here, you would be ready to make your statement of cash flows. For a statement of cash flows, you need previous year's balance sheets. We're going to omit the statement of cash flows for this particular example just because it's a lot of information to bring in. There's already a lot of information in this chapter. Don't you worry, the statement of cash flows is coming up later in the semester. But for now, let's assume somebody else made that statement of cash flows, and we are going to finish up the last two steps of the accounting cycle by closing our temporary accounts. Your temporary accounts are what I call your tracking accounts. They're all the accounts that end up on your income statement and the dividends that you paid during the period. So for account types, they are your revenues, your expenses, and any withdrawal dividend accounts that you had. All of these that contributed to your company's net income, or hopefully not, net loss during the period, need to be reduced down to zero. They're tracking accounts. How much the balance of those is how much of that occurred during the period. In this case, the balance of all those accounts for us is how much revenue, expense, or dividends that we paid during 2025. Well, at the end of 2025, we want to start tracking for 2026. To do so, we have to reduce them down to zero or close them. So make sure that you are only closing your revenue, expense, and withdrawal or dividend accounts at the end of the period. Your assets, your liabilities, and all of your equity accounts, less anything that's to do with dividends, have to stay open. They have to stay at their current balance. They are permanent accounts. So how do we close those accounts in terms of journals? Well, there's actually a way you can do this in one giant journal entry, but the most common way is to use the income summary method, which is four entries that you're going to use. The first one is going to close out all of your revenue and gain accounts to this fake made up count we use only for this transitional account, if you will, called income summary. The second entry closes out all of your expense and loss accounts to that same income summary account. And then after that, you're going to have your balance of income summary, which needs to be closed to your retained earnings. And then lastly, you're going to close out your withdrawal or dividend accounts also to your retained earnings. So let's do it step by step. We had $167,500 worth of revenue during the period. We saw that on our income statement a minute ago. That'd be the balance of our service revenue account, a T account, or in our general ledger. And it would be a credit balance because accounts always balance on the side they increase on. Revenue accounts increase on the credit side. We'd have a credit balance of service revenue. How do we reduce it to zero? By debiting it for the same amount. So we would debit service revenue for 167,500. And every account, every entry has to have a debit and a credit. So what do we credit? This income summary account that we are using to close out our transactions. So that is how your entry to close revenues to income summary is always going to look. You might have more than one revenue on your books, but it's always going to be a debit to all of your revenue accounts for their current balance and a singular credit to income summary. Then you're ready to move on to your second entry, which is to close your expense accounts, but the same principle holds true. You want to go and find the current balance of all your expense accounts, and we have them here. Expense accounts always increase on the debit side, so they'll have a natural balance on the debit side. And if those accounts have a debit balance in your T accounts in your ledger, you need to reduce them down to zero by crediting them for the same amount. So this is what the entry to close expense accounts always looks like. You've got tons and tons of expenses on the books, but you are going to credit each and every single one of them at the end of the period. And then your debit is going to be to income summary for whatever makes your debits equal your credits. And right now, our income summary T account would have a $167,500 credit in it and a $74,000 debit to it. What will be the balance of that account currently? It would be the difference between those two numbers, which is $93,500, which you may have seen before. It is our net income that was reported for the period. we need to close that income summary, if you will, to our retained earnings. And since after these first two entries, income summary would have a credit balance, we need to debit it for whatever its balance would be, that 93,500, to reduce that to zero. And the credit would go to, in this case, retained earnings. So if your company was profitable during the period, this is what the entry to close income summary to retain earnings is always going to look like. A debit to income summary for whatever its balance is after the first two entries, which should always be the same as your net income on your income statement, and a credit to retained earnings. If you unfortunately had an unprofitable period, well, now it's the flip. You would have to credit income summary and debit retained earnings. This entry doesn't flip. Dividends, as a withdrawal account, always has a natural debit balance. We paid $2,000 worth of dividends during the period. Our dividends account would have a $2,000 debit balance at period's end. To reduce that down to zero, you need to credit it for the same amount. It's 2,000. Retained earnings is an equity account. And in this case, since we're not retaining it, we need to decrease that amount. We would decrease it with that same debit for 2,000. So that entry is always the same. This is the only one right here that can really flip upside down. It depends in this case if you are profitable, or if you flipped it upside down, it would look like you were unprofitable. But now you have all of your temporary accounts reduced to zero. You are going to only have balances to your asset, liability, and equity accounts at period's end. And to make sure that those have debit credit equality before you officially close your books, you one more time make a trial balance, your post-closing trial balance. And here for Plush, after we've accounted for all of the closing that we did after we made our financial statements, we see that this company still has debit credit equality for the collective balance of all of its asset, liability, and equity accounts.